Fund Show. I'm Neeraj Shah, and it's a very interesting time to be a part of mutual funds as an industry. Simply because if you're an investor, that is, because if you're an investor, let's assume you got on your raise. I hope everybody gets them in your respective organizations, or you make lots of money, lots of profits in your business, and you want to invest, but you're cagey about equity investing because equities are looking like a bit of an iffy lot right now. So you think about fixed income, but when you're looking at fixed income, you're suddenly bombarded with all of those options about how interest rates are on the way up, and therefore what in fixed income do you choose? On top of that, platforms like us do a show. Last week, for example, we did a show that mutual funds are not the only game in town, because you can also look at options like the neo banking savings accounts, which give you an option of up to 5 lakh rupees guaranteed by RBI with a return of 7%. Having said all of that, it pays to at times hear what people who are entrenched in this system for such a long time have to say about where to invest and what products are the ones to look out for. So ICICI Prudential Mutual Fund has apparently made this big call on floating rate bond funds. Now, we thought it best to get in Manish Banthia, he's Senior Fund Manager Fixed Income at ICICI, to join on the show and tell us if he indeed endorses that view, why or why not, and what are the kind of, what are these funds and what are the kind of returns that investors can expect from them. Manish, great having you. Thanks so much for joining on the Mutual Fund Show.
Thanks. Thanks a lot, Neeraj. And thanks for, bringing me on this show. It's an opportune time for me to engage with the audience to make them understand, what kind of instruments should one look at in the current market juncture. Because what has happened over the last, few years, I would say not months, in fixed income is that we've only seen yields go in one direction. From 2014, when yields were 10-year yield was as high as 9.5%, to where it is right now around 7%. I mean, yields have only come down. In fact, the shorter end of the curve, the 1 to 2 year yields, the FD rates, which investors normally, invest in mass, in bulk, they have only seen downward trajectory. And therefore, it is an interesting time to think what one should do in terms of their investments in fixed income when things have changed. And the reason why I'm saying things have changed is because last 2 years have been years of recovery for the economy. When the economy is in recovery, there's a different sort of investment, opportunities which you need to look into the markets. But when the economy has moved from recovery to expansion, when generally your capacity utilizations are kind of now filling up, your inflationary pressures are moving up. Interest rates in these environments, they tend to move up. And in a rising interest rate scenario, a fixed yield bond normally may not be the right instrument to invest. For the audience, to make things simple, in a fixed rate instrument bond, if you have a 3-year bond, right, you are fixing your yield right now. If yields are going to move up, in that journey, you're going to lose money. On the other hand, when yields were going down, if you were investing in a fixed rate bond, when yields were moving down, you were actually making money, more money than the coupon of the bond. So therefore, in a rising interest rate scenario, you cannot choose a fixed rate bond, because the fixed rate bond will come up with a lot of volatility, a lot of, pain along with the volatility. So you have to choose instruments which not only increase your effective, coupons as you move ahead, because as the interest rate rise, you would like to have better coupons than what you're locking in right now. At the same time, you also need to have some capital gains along with that. Floating rate instruments are the instruments which provide you the solution. And the reason is, these are instruments which are linked to market benchmark rates. It could be either a 3-month T-bill, a 6-month T-bill, or a MIBOR rate, which is the overnight rate. And they offer a spread over and above that. As the Reserve Bank of India increases interest rates, the market benchmarks also move. And along with change in market benchmarks, your coupon change at intervals of time, periodic intervals of time. So for example, the Government of India issues, government securities, which are linked to 6-month T-bill rates. And they are issued in different maturities in 5 years, 10 years, 11 years kind of buckets. When one chooses to invest in such instruments, when RBI increases interest rates, the 3-month, 6-month T-bill rates also move up. So every 6 months, your coupon is being reset higher. And the beauty of these products are that at present, these products are pretty cheap compared to what is being offered by rest of the market. When I say these products are cheap, the spread which are being offered in these products are pretty high. So, for example, a 5-year Government of India or 6-year Government of India floating rate bond that is offering a spread of almost 90 to 100 basis points over a 6-month T-bill. So, effectively, to start with, you're already getting around 5.5% of coupon. So, suppose if RBI increases interest rates by 100 basis points in the next 1 year, this 5.5% can go to 6.5%.
Okay.
By the way in which the OIS market, which is the interest rate swap market, is pricing the forward curve, the overnight index market is already saying that 1 year ahead, the 1-year curve would be at 6.5%. So we're already seeing a very sharp increase in the short-term interest rates in the next 1 year. And therefore, if one invests in these kind of instruments, one not only gets the benefit of higher coupons. Generally, we've seen that as interest rate moves up, the overall, coupon on these bonds become attractive for overall investors. The demand from overall investors also increase. So there are also chances that the attractiveness at which these, bonds are priced right now, that attractiveness can compress, effectively meaning that the yields can compress. And when the yields compress, you get additional benefit out of it. So something which is available at 100 basis points right now, when interest rates, start to adjust at 5.5%, the relative attractiveness from an overall yield perspective becomes higher, and people will be okay to buy at 80 basis points rather than 100 basis points. That movement from 100 to 80 basis points gives you an additional carry. So effectively, you're not only gaining the coupon part of it and the spread, but also there are opportunities to get into, capital appreciation gains in this segment. So therefore, from all these perspectives, if we think that one, they are the opportune instruments in a rising interest rate scenario, the valuations are pretty cheap. And number three, from an overall perspective, as compared to all other fixed interest instruments, they are very attractive. So be it an FD, be it any other 2-year, 3-year fixed interest rate bond, these instruments are looking as the most attractive investment points from fixed income perspective.
Got it. Manish, so that's a detailed answer. I don't need to ask anything more on this, but can I ask you, so what within the ICICI table is the option for people to choose from if they are convinced by this argument?
So the clear option is to choose ICICI Prudential Floating Rate Bond Fund. The strategy in that fund is to invest predominantly in floating rate instruments, which are linked to market benchmarks. And, as per the last filing, of portfolio, more than 65-70% of the portfolio is invested in, these bonds, which are linked to either, treasury bills or they're linked to MIBOR kind of benchmarks. So effectively, if one looks to invest for the next 1 year's period at least, where it is expected that RBI's rates are going to push up, these kind of strategies will make a lot of sense for investors.
Great. Can you tell us the risk associated with this investment very quickly?
So the risk associated with this investment is, if, for some reason, the economic scenario changes completely and RBI, instead of hiking interest rate, starts to think about cutting interest rates from where we are sitting right now. So what I'm saying would not make sense from investors' perspective. Investors would likely, be better off being in a fixed rate instrument rather than a floating rate instrument. But if RBI was to hike interest rates, I think these instruments should make sense for investors.
Got it. Okay, Manish, great having you. Thanks for taking the time out and giving us some sense of what this is and where within the ICICI stable can one look at as well. Really appreciate your time.
Thanks a lot, Neeraj. Thanks.
The pleasure was ours. Well, viewers, so that's the view from the house which has made this call that people should invest into these floating rate bond funds. Now the question is everybody on the same page? Why or why not? And are there other options beyond these as well? Remember, last week we did a show where we told you that mutual funds are not the only game in town. For example, there are savings bank accounts on the neo banks which give great rate of return as well. But let's restrict this commentary to maybe the mutual fund options available. Get in two experts who look at this a set of investments and instruments very, very closely for their clients, as well as come on the show quite regularly. At least Gurmeet Chadha, who is joining us, does come on the show regularly. And for the first time, we also have Mohit Gang. Gurmeet is, of course, senior fund manager, co-founder and CEO of Complete Circle Consultants. Needs no introduction really on the mutual fund show at least. And Mohit Gang, for the first time, co-founder and CEO of Moneyfront. Gentlemen, both of you, thank you so much for joining in. Gurmeet, just before we got you guys on air, we had a representative from ICICI Mutual Fund, and they seem to be giving this call that in a scenario wherein interest rates are set to rise, fixed rate funds will not be a great idea, and people should necessarily choose floating rate funds. What is your view?
So Neeraj, I think partially agree, that, since rates are going up and some part of the portfolio can be considered, but this has to be a satellite bucket. It's not as simple as it sounds. Not all bonds are floating rate instruments. Supply of floating rate instruments hasn't really gone up this year. I mean, Mohit can add more. He tracks markets more closely on that. So which means that if the corpus grows, you have to start doing OIS, which is swaps, to make up. So any floating rate fund has to have 65% exposure to floating rate bonds. And if you don't have so many floating rate bonds available, you go for OIS, which are these swaps where you exchange fixed rate with a floating rate. And what we saw last year, that despite the rates going up, rates have gone up in the last 6 months, the performance of most floating rate funds have actually been in line. If you see 1 year return, let's say for most floating rate funds, include all big fund houses, it's been around 3.5 to 4.5% bracket. So I think you have to take a call that how much of the yield curve is pricing in. So for example, look at 2-year OIS. That is what is used to swap the fixed rate with floating rate. It's gone up from 3.8 to 5.7. In last 1 year. So let's say if yields don't move at all for next 6 months, possibility, right? So you are swapping your fixed rate with an OIS rate. So that part of the portfolio which you are hedging, may not yield you too much. So it's a little technical for retail investors. Yeah, so it's not as simple as that. You just bought floating rate bonds, linked it with MIBOR, rates go up, and typically people assume that coupon is getting resetted every day. Coupon also gets reset with a bit of a lag. So I think it is a little for more evolved customers. You have to have a definite view on interest rates. Your understanding of yield curve has to be very, very good. So yes, some part of the portfolio I think can be considered, but it can't be the core allocation in the portfolio. It can be in the satellite as far as the fixed income is concerned.
Okay, Mohit, you want to add to this? And of course, your answer can be different from Gurmeet as well. But what is your thought? Should people actively look at a larger part of their portfolio, the entire portfolio in floating rate funds, simply because the rates are most likely slated to inch up higher very swiftly?
Yeah. So look, I kind of broadly agree with what Gurmeet was saying, and that fact is well established now that rates will go up. It's a matter of when and not a matter of if or whether it'll go or not, right? So globally, rates have been inching up. Fed has already done the first hike, and in India, we are likely to see it fairly soon. Without a rate hike, the 10-year yields have inched up from almost a low of 5.7 to 7.1, right? So there hasn't been a single rate hike in last 18 or whatever, last fairly longish time. And the 10-year yields have moved. And if you see the entire theorem of floating rate bonds, which was the same theorem which was given last year and much before that also, that when the rate cycle turns away, the floating rate bonds will be very well established to capture the upside also, because these are finally floating rate instruments. But I think the technicality out here is fairly large and complex, which Gurmeet alluded to. Minimum 65% of the portfolio has to be in pure floating rate instruments. In India, you don't have floating rate instruments. There are hardly any pure floating rate instruments. So you go and do these OIS swaps, and the OIS swap curve was so steep last year that hardly any of the floating rate funds could give you any return, right? Even today, as we are talking, the curve is fairly steep. And unless you see very fast and quick rate hikes in succession, which means you're seeing 50 bips hike or something which is beyond the market expectation, that is when a floating rate fund will actually end up giving you a slightly largest return, or a return which will make you feel happy. So to keep it short, I think for debt, it has to be a very simpler strategy. If you really want to play it safe, which is the objective of a debt fund, then you be at the short end of the curve play the money market funds, ultra short, or at best low duration right now for minimum 6 months to a year. After which, once you see that the rate cycle or the rate hike cycle has started going up, the yields have fairly risen, maybe you are at around 7.75, inching closer to it. That's the time when you start actually moving to the long end of the curve or start moving towards instruments which have larger maturities and larger durations. To my mind, it's complex. You have to be a pro in getting into floating rate funds and a pro at coming out also. Though the modified durations are not very steep, they show on the paper it's around 1 year, but again, that's not a pure modified duration because the OIS durations are not counted in it. So it's a very mythological kind of concept. I'll remain away from it as of now, and I'll play the shorter end for the time being.
Viewers, lest you get confused a little bit, don't worry. I'm also in the same boat, but let me try and simplify this even more. So Gurmeet, I'm going to ask you a question that on the basis of what the AMC representative said, which is that here's the catch, right? A viewer who heard this show thus far has heard one argument saying that if the interest rates were to be hiked by 100 basis points, then not only will the return on the floating rate fund move up by that much, but there's also a chance of some bit of capital appreciation. Now, my question to you is, and he believes that the only risk to this argument is if the Reserve Bank of India doesn't hike rates, but cuts rates. My question to you is that a valid argument, or are there some chinks to that theory?
So there are some chinks. I'll give you a very simple example, and I'll try and make it as simple as possible. Let's say I have a 5-year bond, and let's say the 5-year bond, the coupon is 6.5%. Okay, and let's say I take a 5-year OIS. I'm just making it simple. Usually people take short, but let's take and there let's say it is about 5.86. So let's say interest rate goes up by 100 basis points, right? So if interest rate goes up by 100 basis points, the 5-year bond will have a 3-year kind of a mod duration. So 3 into 100, I have a 3% mark to market impact. Very simple, 100 basis points rate. I'm just doing it. It's not linear, but I'm just trying to, simplify it. And typically what happens is, Mohit was also saying, the OIS curve has also been steep. Typically the rise in OIS is lesser vis-a-vis a normal plain vanilla bond. Let's say that also goes up 80 basis points, right? So here I lose 3%. And there I gain, let's say 2.5 to 2%. So it's a bit of a hedge in my view in terms of gain, not losing out materially in case interest rates goes up. Strong. I mean, I'm saying the OIS has to, as Mohit was pointing out, unless there are very sharp hikes, which personally I think I'm not in that camp that RBI will, because what we have seen in US also, Neeraj, is that mortgage rates going up to 5%. That the home sales fell by 10% as per yesterday's data. So it's a tough job for us being a central banker, pulling out liquidity, raising rates, ensuring that you don't kill demand. You have to moderate demand, right? So sure. I think keep it more simple as Mohit was saying. I think if you understand the yield curve very, very well, I think as some expert investors can take, a part of the portfolio, maybe that you're hedging it, okay, maybe 10-20% goes to floating rate fund. So you're hedging yourself that yields go up very sharply in some part of the portfolio. My damage would be, contained. If not, there are any gains, right? Also, a very important point, the yield curve is pricing a lot of things. So look at, for example, the 5-year bond today. It's already touching 690. The 2-year bond, government bond, if you see, or 3-year government bond, it is below 6. So right now, the 4 to 6 year segment of the yield curve is actually pricing in 100-150 basis points. In my personal view, is almost pricing everything. I mean, I could be proven wrong over a period of time. So you have to be also careful that by doing all of this, you are also compromising a reinvestment risk, right? So let's say if you buy a 2-year short maturity, you get, let's say 5.5%. But if you today buy a 4-year, 5-year maturity, you are getting 7. So to make up that, and let's say yields don't change, the reinvestment risk also goes up, right? The yields have to go up. So you have to be a little careful, bucket it carefully. 1 year, as Mohit was saying, money market, long term, go where the yields are showing some steepness, keep something in floating, no harm keeping something dry powder, wait for better yields. And so it has to be a more mix and match and a balanced approach to the portfolio.
Okay. Mohit, I guess from your answer, you are staying away from floating rate funds. You don't want to park any of your monies there, right?
Look, I think broadly short end is where I would park my money. And if I really want to play the long end, as Gurmeet was rightly saying, then you have to be more sure and play the entire cycle out. So I'll rather go with a target maturity fund or a roll down fund today. Let's say I'll go with a Bharat Bond series 2030, 2031 kind of a paper where the yields are already at around 740, 750, right? I'd rather sit like an FMP. It's an open-ended FMP. It gives you all that luxury to get in, get out anytime. And it's the highest quality paper available in the country today. It's the lowest cost product available in the country today. If you are a debt investor and want to be in debt for a fairly long while, then nothing better than that, right? You stick to your guns and be at that in a roll down fund. Floating rate will give you the YTM of the fund, more or less. If let's say if the interest rate hikes are able to match the OIS curve pricing, but unless the rate hikes are very sharp, that's when you make that extra additional 50 bips. So at best in floating rate, what you make is the current YTM 525 roughly odd, with 50 bips of aggressive rate hikes giving you some kind of a bonus point out there, making it around 550, 575 odd kind of a return. But chances of that happening is fairly low, because RBI thus far has refrained very, very, I would say, commendably on not increasing rates. Basically, they've been doing all kinds of tinkering. The yields have gone up, but the rates have not increased, right? So it's a very tricky job out there.
Yeah, not directly increased, at least until the last policy. But the last policy had some fairly interesting moves as well. But the point is really well taken. Thank you. Thank you for explaining this in a really simple way, both Mohit and Gurmeet. Can I just therefore ask you then, what's the best option for somebody who wants to choose the debt fund route? Now, Mohit, I know you mentioned that you will stay at the short end of the curve, and at the long end, you will probably say the target maturity funds. But I was talking to Gurmeet before the show, and Mohit, I want to start this conversation with you. When Gurmeet was, or probably is, of the opinion, and Gurmeet, you can correct me if I was wrong, but Gurmeet was of the opinion that typically when rates have, the 10-year crosses a particular threshold, long-dated fund, long-dated options, gilts, give some pretty decent returns over the course of the next 2 or 3 years. What are your thoughts here, Mohit?
Oh, absolutely, absolutely. And I think Gurmeet has been a pro on that. He's seen many cycles out there, but that's a fair point. If you see the 10-year crossing 8%, Neeraj, though this time the rate cycle at the low end was also very long. So perhaps towards the other end also, it could be a fairly long wait before it starts to turn up, because inflation seems to be like a real monster this time, as in the numbers are like absolutely big and scary. So perhaps the cycle can be a little longish on the long end also. But beyond 8, if you go into long dated funds, and that's been my experience, at least in the Indian bond markets, basically Indian debt funds, especially if you have that patience of waiting and let the yield cross the 10-year yield cross the 8% mark, and then enter long dated gilt funds as high maturity as you can, go and sit tightly out there for another year and a half or 2 years maybe, and you will make superlative returns. I have seen investors honestly making high double-digit returns on gilt funds in the 2003 cycle, and later also, after post the financial crisis, there was that one cycle where investors made supernormal returns in gilt funds, basically. But you have to get the timing right on this one, and you have to wait out patiently for your time to come. Even beyond 8, it can lead to some mark-to-market losses for some while, and if you're not patient and tinker around with your portfolios, and it won't give you that kind of a return. If you're more the patient variety, want a very steady flow, look, honestly, corporate deposits at around 750 right now is not a bad bet if you really want to lock in for a 2-year, 3-year kind of a thing. And then you have all these other NCDs and other instruments also, which keep coming up in that range, right? So those are also decent options for investors who just want to stay put and don't want to play the rate cycle, right? And you sometimes you're quite satisfied with getting that 7 to 8% yield. If you know on a confirmed basis you can make that much in 2 years, then you don't have to like really tinker too much on the with your debt portfolios. But yes, for people who really want supernormal returns, wait for the yields to cross 8, then enter the long end, and for the time being, short end is my favorite place.
Gurmeet, wait for the yields to cross 8 now. There are people who are saying that, hey, the yields have done their move and they did not necessarily really move. You'll see the rates move, but the yields need not necessarily move. So did I get your thought process captured correctly, Gurmeet? Is that the thought process? And would you also wait for the yields to cross 8% or circa 7.25, though there are 7, but 7.25, 7.5 is also a good time to start deploying some cash?
So Neeraj, I will do it in three buckets. One bucket is where I find the yield curve very steep is the 4 to 6 year bucket, which I made a point that you're already seeing 6 year, 5 year, 7 year bonds almost touching 7, the government bonds. In fact, you'll be surprised the spread with AAA of 5 year and government bond is only 6 basis points. So actually, you're not gaining anything by going from GSEC to, let's say, a AAA bond at the 5 year is concerned. Usually, the spread is 60, 80 basis points, right? So I think with Mohit was alluding to, there are a lot of target maturity funds of 2026 maturity, 27 maturity, which are giving you that YTM closer to 660, 680. I may be tempted to put something there. I may not want to go all out because you can't get the top, but the yield curve is definitely steep. Repo is 4. Shorter end rates is 5.5, and you're getting medium end at, let's say, almost 7. So it's pretty steep, probably pricing in 100 basis plus rate hikes. At the longer end, I would tend to agree with Mohit. This is again for people who can manage volatility, because GSEC can hit you both sides if yields harden, and the yields can harden very quickly also. We saw 25 basis movement in yields in last 2 days, because on the 10-year. So it is not for the weak-hearted. We did an analysis, okay, that moment it crosses 750. The 3-year returns have always been 8%. So I'm giving you statistical data. So whenever you enter, it crosses 7.5 and you hold it for 3 years, it is typically around 8%. Whenever it crosses 8%, which Mohit was saying, the returns are then much, much better, because then you get a big MTM gain. So for me, it is that 7.5, 8 corridor. Keep some powder dry in liquid ultra short term for the time being. Have some target maturity fund for a 3-year, 4-year horizon, and just keep it a little light. I also think an STP, I know it sounds very weird, an STP in a long dated GSEC may not be a bad idea with, let's say, a 2-month kind of view. But you not have heard STPs in debt fund, but if you can't time things to perfection,
True.
But if that can also be considered.
Okay, so gentlemen, I'm going to request you, yaar, thoda simple karte hain. For somebody who's heard this whole conversation and is still, so has understood the concept, but doesn't quite know which house to go to, where to choose, etc. Gurmeet, I'll start with you. After that, I'll go to Mohit, and then I'll come back to you if you want to make a change or two, because you're not getting time to think. But I'm going to ask you that if I have 10,000 rupees right now, I want to park it in debt funds. And let's say my time horizon is between 1 year to 3 years, or maybe slightly over 3 years for indexation benefits. Let's say I give you that leeway. How would you divvy up this 10,000 rupees? Average returns anticipated.
So there are basically 3 parts. Some part,
and give me the names of the funds as well. Sorry.
Perfect. I'll do that. So some part I would either maybe 25% or 30%. I will keep it in low duration money market instruments. We can choose Birla. You can choose ICICI. There are good money market funds. You can choose either. There's not much difference, to be honest, at that side. Some part, as Mohit was also saying, I will put in target maturity funds with a 3-year view, where I am getting closer to 7%. There are a lot of fund houses which are giving an SDL plus GSEC portfolio also. SDLs are typically at a slightly higher rate. Bharat bond, Mohit mentioned, is gone up to almost 730, 740, but that's a little higher maturity. Some part of the money will go there. Rest money, I would right now keep powder dry, wait for yields to turn a little better. I also don't mind RBI floating rate bonds. To me, that's a genuine floating rate bond. Offers you 725, and it's indexed to the to changing rates. May not be a bad option. Unfortunately, the lock-in is 7 years. So, and because it is interest taxation, so if you are in a lower tax slab and you want a very long term, may not be a bad idea.
Okay, so 50% invested, 50% gunpowder dry, and that 50% is divided up the way you thought. Okay, I'll come back to you, Gurmeet, if you want to change it a bit. But Mohit, to you, how would you divvy up 10,000 bucks?
Look, so I think 50% of the money will go into money market funds right now for me, which I think, or ultra short perhaps, which is the safest place. And then this 50, I will then flip it across into GSECs if I'm a pure play debt guy and I really want to play the debt cycle. Then I'll flip this into GSECs or long dated gilt funds once I'm satisfied, or once I know that my threshold yield has crossed, and that barrier can be 8 or somewhere around that mark, right? On the money market side, I'm fairly comfortable with most of the funds, but let's say an ICICI money market, an Aditya Birla money market, even Tata money market has been doing fantastically well. So those are good choices. On the remaining 50% of the portfolio, I think around 25% can go into target maturity. If the horizon which you said was 1 to 3 years, then perhaps we're left with choices which mature at around 2026, 27 kind of a series. So you take the Aditya Birla Sun Life SDL series out there, or even you have a Kotak and an Axis SDL funds. Now SDL is a mix of state loans plus some G6. So state loans give you that extra kicker or bump in the yield, right? Pure government papers can be slightly low on the yield. So I think those SDLs are quoting you an yield of around 6.5, roughly, give or take 50 or 25 bips plus minus. So that could be a good way of capturing that yield, being in a target maturity or a rolled on fund. And it's like an open-ended FMP. As I told you, it works like an open-ended FMP, and the paper quality is absolutely high, right? And the remaining 25% I would want to go out and lock it into a corporate deposit. Even RBI floating rate bond, which Gurmeet said, is a great instrument if you have the time tenor of locking it for 7 years. But 1 to 3 years, then you go for a corporate deposit or an NCD of any of the good rated, AAA rated issuers. And I think you're getting 7/4 out there. That's not a bad deal. 7/4, 750 even, right? So that's a great deal to lock.
Great. Because maybe 1 to 3 years might not be the time frame for the target maturity funds. I restricted them, but it seems that if you want, you can choose target maturity funds with a slightly longer tenor,
yes,
and you get that 7.257. I presume that the Bharat bond has, or some.
Plus, I think the benefit of indexation kicks in, Neeraj, out.
Comes in after.
Let's say if you're buying a Bharat bond fund or 2030 maturity where the yield is currently 749, 750, right? You making those 8 indexations, 7 indexations on the way, and it becomes highly tax efficient as an instrument. So it's a great investment.
True. Gurmeet, any changes, or you find with what you've chosen?
Yeah, probably. I think indexation, if you're locking in, go for indexation. Don't just go, as Mohit said, keep at the shorter end. Take the 3-year indexation. So if you get 7 pre-tax, post-indexation with current inflation, post-tax could very well be 6.5, 675, which in a layman language is like, pretty good yield.
Agree completely. Well, gentlemen, thank you so much. You've been very patient with me, and I'm sure our viewers would understand this really well. And thanks for being candid about the conversation today. Really appreciate your time.
Thank you.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.